Thanks so much, everybody, for joining us. I'm very excited to be here. I'm Vildana Hajrik. I cover markets at Bloomberg. And as Callie said, private credit is the big hot topic right now, and I'm really pleased to be here with you guys and chat about some of these things. So thanks so much. I feel like the private markets space can be a bit opaque at times. So I was hoping we would actually just start very briefly, if you guys can just tell us like what your roles are, what you do, just to get for all of us to get a better understanding of what we're going to be talking about.
Sure. Great to meet you. I am a managing partner, co-chief investment officer with Peak Altitude Partners. We are a private markets firm focused on curating access to our partners that include RIAs, family offices, endowments. And prior to that, I was at Goldman Sachs. I was the co-head of private credit within alternative capital markets, so providing access, structuring, curating, and ultimately helping syndicate private markets to our $1 trillion of private wealth clients.
My name is Jeff Garden. I am a senior managing director and chief investment officer at Lido Advisors. And as you would assume from my title, all things investments eventually end up on my desk with my team, and that means curating and finding the ideal investment opportunities for our clients, and within that, a lot of private investments, private credit among those.
So I think we'll get, in a little bit, we'll get a little bit more into what exactly that entails. But maybe, Josh, we can start with just defining what private credit is and whether or not, you know, when people are thinking about private credit, there's some sort of misconception of what it actually entails.
Yeah, sure. So first of all, private credit market today is around $1.5 trillion of AUM. That's grown almost by double since a decade ago. It's expected to grow to about $3 trillion by the end of 2030. So clearly there has been a lot of focus within the private credit market. Private credit expands across all cash yield, total return, and distressed strategies in structurally senior debt instruments. So the way we think about it generally is that in today's world, private credit should allocate across all of bank loans, direct lending, asset-based financing, mezzanine loans, and then also within special situations loans as well.
Yeah, I would say that's a pretty good summary. You know, direct lending, obviously the most obvious and the most straightforward, but after that you do get into mezz finance, specialty finance, structured, things that you really shouldn't be ignoring, particularly now, but a lot of people tend to kind of ignore or put somewhere else.
Well, say more about that. Why shouldn't we be ignoring it, and why, as you said, especially right now, what is it about this moment?
So, you know, I think private credit, direct lending has been around for a long time. It's not as new as people think or as new as it seems. And, you know, if we were having this panel 5, 6, 7 years ago, then I think the story would be direct lending, and it would be, you know, the strong underwriting and healthy covenants and the due diligence process that a lot of these firms and operators have the ability to do versus, you know, just going out and finding, and creating a bond portfolio or a high yield portfolio. But the story has evolved, and, you know, we had a pretty significant event that impacted a lot of smaller companies and a lot of middle market companies, and that event was COVID, and they needed a lot of capital to stay afloat, and now a lot of those loans are coming due, and we have that so-called wall of debt, and that's an entirely different animal. That's not just direct lending. That, you know, that is reorganizing and rebuilding a capital structure in a way that will allow a company to survive, and not every direct lender can do that.
That's a great point. And I would also add that as you think about this market, wealth in particular, I think direct lending has always been, or has been over the last 5 to 7 years, the go-to within private credit. It's been used synonymously with private credit. We believe that, yes, direct lending is important, cash yield is important. There's a lot of other product within that set that's also important, including bank loans, as you mentioned, including distressed. If you think about the market today more generally, over 85% of companies with over $100 million of revenue are privately held. And so if you were to only think about the public markets, only think about direct lending, you're missing out on a large portion of, one, private companies, or companies in general, and then two, part of the capital structure that isn't just direct lending.
Well, I've heard a lot of the panels here at the conference the last couple days, and this idea of companies staying private for longer has been coming up quite a bit, actually. So is the idea that private credit is an important topic right now, is that one of those factors, or what is it that is making us all think about private credit so much over the last couple of months? I mean, it really has heated up as a topic.
Well, you know, I think if you look at a bank's balance sheet, you know, I'm not talking about the big guys. I'm not talking about bulge brackets. If you're looking at a regional bank's balance sheet, you know, pretty much since '08, they really just want to loan money to the government, and you see that by kind of taking a look and understanding how much U.S. Treasury exposure a bank's balance sheet has. And if you're loaning money to the U.S. government, then you're not loaning to private companies. You're not promoting the kind of business activity that banks used to promote. You know, you're not contributing to the growth of the U.S. economy the way you used to. And somebody's got to come in and fill that void. And somebody's got to come in and fill that need. And the private credit markets have really stepped in and done that very, very well, I think.
Yeah, look, compared to the traditional public credit market or the syndicated market, there's clearly ease of use in private credit. So I understand why borrowers want to go to private credit lenders. You get, one, a much more truncated timing for when you get capital. You get execution that you're almost guaranteed to arrive. And then you get a very curated list of lenders opposed to going to hundreds of different parties. So your company's information is much more secure. I think that private credit will certainly grow as a result. Direct lending will certainly grow. But the term private credit and the entire stack has been here for a long time. I think it's just getting a lot more attention today. One, because SOFR base rate has grown pretty significantly. In 2021, we were at less than 5 basis points for SOFR. Last year, we were over 500 basis points. Today, we're sitting around 430. So there's clearly much more yield that you're receiving today, or return in general.
And sorry, what's behind that, the rise in what you might be getting now versus a couple of years ago?
Was it behind the rise of growth in SOFR?
Yeah, exactly.
Well, that's just Fed funds rates going up as a result of the inflationary environment in the U.S. and, you know, resulting in higher rates, and everything needs to kind of reprice as a result, including SOFR.
And one word, the government.
And what was the second factor? You had two before I cut you off.
I think people are starting to recognize the ease of use, again, of being in the private markets. I think people are starting to recognize that there are a lot more companies today that cannot access public markets. Public markets for credit, you have to be much larger today than you did 5 years ago. It's tough to get a $150 million loan done in the public markets. And so as a result, you have one option, and that's to go into a private market lender. And as people start recognizing that, one, you get better yield, two, you get quality companies, opposed to 10 years ago when it was just risky companies, it was companies that were maybe too small for the public market, or companies that were just too complicated. Those restrictions don't exist anymore. You get really good companies that just choose to stay private for longer, or want to be private because they don't want to deal with the execution risk of the public markets.
Yeah, I would also add that, you know, from the investor side, you know, if you kind of take a look at things from a risk to reward perspective, you know, it's very, very easy to just kind of take a look at investment grade bonds, and, you know, spreads have improved a little bit recently, but I'm still not impressed. High yield, keep it away from me. Like, I'm not getting paid at all for the risk I'm taking. And, you know, private credit, particularly, you know, if we're talking about direct lending, private credit still solves that. Yes, I'm giving up liquidity, but if you really think about it and you kind of look at a few case studies, there's really no guarantee that the liquidity is going to be there in the public markets when you need it either. So I don't feel like I'm giving up that much anymore, and I'm willing to kind of take on that liquidity risk in order to get my clients an appropriate risk to reward profile. So
Yeah, you're just not getting paid for convexity in high yield right now.
that's right.
And Jeff, you mentioned COVID being a pivotal moment for the space, but what about right now? Can you talk about how you're assessing the landscape given the headlines, the uncertainty, the on-again, off-again tariffs, and just the environment overall?
So yeah, I think right now what you're kind of looking for, if you're looking away from just the direct lending space, you are starting to gauge interest in distressed operators, simply because you do have to expect some sort of distress cycle. The last one was really short; it lasted about 6.5 minutes, but you know.
You mean COVID?
Well, yeah, COVID and, you know, the month and a half after COVID, but you know, even during that very, very short period of time, you did find that the right distressed operator found some pretty good deals. They couldn't put a lot of capital to work at the time, but there were things to take advantage of, and, you know, if you were with the right operator, you were able to capitalize on that. You have to assume that there's going to be another one coming, because a lot of the companies that were able to access capital during COVID are not going to be able to refinance in a comfortable way right now. They're just not going to. Yields are higher. They're not going back down to, you know, zero. And as a result, there's going to be some pain, particularly if operationally these companies aren't any healthier than they were in the past. So there will be, I think, if the macro environment kind of continues to do what we're kind of feeling right now, there will be a little bit of a distress cycle. There will be something to take advantage of there. And there will absolutely be opportunities in special situations too, because there are some companies that are absolutely worth saving, and you just need to rearrange the capital stack a little bit.
Yeah, I would agree with all of that. I'd also say that the dispersion in private markets between managers is just so high compared to public markets, where it's such an efficiency of information. In private markets, we think diligence matters much more in some ways, and is much harder to do. So I think that from a diligence perspective, finding a manager or investment in which they have a great track record of performing in a top quartile return spectrum. I think two, having a manager that has a differentiated distribution, or differentiated sourcing capability, because in today's world, everyone's chasing the same deals, and that becomes very difficult. And if people are losing deals on 15 basis points, that's probably not where you want to be. And then I'd also argue that, to your point, like in today's environment, we have public market volatility, geopolitical tension, legislative uncertainty. There's a lot of factors that would lead to us to believe within the next 12, 18, 24 months, there's going to be some kind of disruption in the market. Having a distressed allocation in your and your client's pocket is really just an insurance policy to prevent any kind of further downside in that.
And so these are the reasons. I was hoping one of you guys could sort of solidify the reasons of being in the private credit space versus stuff in the public market. So you just mentioned there's so much volatility in the public market, but there are all these other factors. So, you know, what, for the audience walking away with maybe something to remember about the panel, like what are some of the factors that you would argue people should be looking at for the private credit space versus public markets?
Okay, I think in kind of repeating some of the things we've said, I think one, the number of companies that are private versus public. I think two, the additional yield you get in private markets versus public markets. Three, the convexity generally of the return profile. And then also the quality. I think a lot of the quality issuers are staying in private markets opposed to going public. And then there's also, as long as you are able to do the diligence or work with a partner that can do the diligence for you, the ability to find a quality manager that can deliver returns is an exceptional benefit that you probably won't find in the public markets.
Yeah, I think, I think in addition to that, one of the biggest things that we kind of grapple with whenever evaluating a potential operator is, do you get the call? When somebody needs capital, when somebody's looking for a deal, are you first? Are you first on their list of firms to reach out to, or are you somebody that's going to be kind of participating on some kind of sidecar? Are you a firm that is strong enough and capable enough to spearhead a deal? And if a deal goes south, are you a firm that's strong enough and capable enough to, sit down and have my best interests at heart? Those are all things that we look at for operators. For the space itself, one of the things that we have to remember is that, the appeal of a lot of these private credit funds is in that higher yield, in that higher potential IRR. That comes with some risk. There's leverage there, and you want to make sure that your operator's not pushing it. You want to make sure that whatever amount of leverage is being used, is being employed, is something that you're comfortable with and your clients are comfortable with. And again, this, like we've said a number of times, this is a space where we've seen more and more operators, people coming in, people flooding it, people trying to take advantage of the opportunities here. And this happens every time. There's just going to be some poor operators that things don't work out for, and you don't want to be with those.
Yeah, I love this quote, "You can't be a tourist in this space. You have to stick to what you're good at." And to your point, like private credit, direct lending specifically, has blown up over the last 3 to 5 years. It seems like every single credit firm or equity firm, doesn't matter what you do, now has a direct lending shop or a BDC. And we think that that's dangerous. We think that there's a lot of people out there without differentiated ways to think about investing, sourcing, or even exiting positions. Maybe a great example, my partner and I were speaking to a well-known firm north of $25 billion.
You can name some names.
And we were asking why they needed $3 to $4 billion this year, 75% of which they wanted to deploy. They have no differentiated form of sourcing. They even said, we are not seeing quality deals. We're losing deals based on somewhere between 15 to 30 basis points. Everything added up to they should not be raising capital. So we asked them point blank, why do you need capital in today's environment? If you agree with us, that's not going to be great for you. And the CIO just kind of stared at us blankly of, I've never thought about it that way. It's kind of dangerous, and the fact that they're going specifically to wealth is even more dangerous.
Jeff, can you talk a little bit about, because as we mentioned, private credit is just becoming a hot topic. When clients are coming to you, what exactly are they asking you? What are they talking about?
So I think the two things that the clients we deal with are, most commonly concerned with is the yield, and that's always kind of a tricky conversation for them, and the liquidity. How long am I not going to have access to my money for? The larger the client, generally speaking, the easier it is for them to kind of deal with that illiquidity. It's not going to impact their life. It's, the probability of them actually needing that cash in a pinch is fairly low. But smaller clients that are, kind of taking their first step into this space or into privates in general have just had kind of stock and bond their whole life, and they've got $2 to $3 million, and once it's allocated, it's allocated. That's a pretty big deal for them. That is a pretty big question, and it is a pretty big concern. And obviously, there are ways to deal with that and ways to help them kind of relax there. But that I would say is the biggest concern. I think right now, particularly when it comes to direct lending, the risk to return profile is such that they're willing to kind of accept the liquidity risk and accept the fact that their cash will be tied up, but that has not always been the case. So,
Josh, is it for everyone? Is a private credit allocation for everyone? Because I do want to also get into the idea of like democratizing the space, because obviously we now have a private credit ETF that is aimed for the retail investor, and I do want to talk about that a little bit, but maybe just talk, like, is it for everybody, which is, you're touching on a little bit there, Jeff.
Yeah, I don't think anything is for everyone. Let's start there. I think there's eligibility concerns. I think that there's concerns about what is it that you're trying to target within your investment class generally. So I think that we took that in one side and we thought about the structures that private credit are in today: drawdown, interval funds, BDCs. We can talk about ETFs. There's various different vehicles there that may be suitable for various client types. That all being said, I think that it's great that the credit space and maybe alts generally is expanding, innovating, continuing to think about new products and new ways to come to market and to bring new people in. I think that it is likely dangerous where, again, without naming names, we had a product
You can
drop.
name names.
Had a product drop over the last week or two with very little details. The SEC wasn't happy about it. And for something in which we think about long-term allocations for our clients, what was the rush to come to market aside from just becoming larger and thinking about getting management fees? So I think that there's real concern around some of these structures and clients that are being put in, and the illiquidity around private credit and the fact that you're making a loan to a company and putting it in a vehicle that has perceived liquidity. So there's that. I also think that the term democratizing alts is dangerous in a lot of ways. I would urge you and your clients, next time you hear someone say they're going to democratize alts, perhaps cease all future communication with that individual. There's a lot of different ways to think about alts. There's a lot of different ways to think about your allocation, but I would think that instead of democratizing, maybe we should be curating, rigorously diligencing, thinking through how to create a portfolio that's bespoke to you and your clients.
yeah, I mean, I've seen this before. 10 or 12 years ago, we were all talking about taking hedge fund strategies and putting them into 40 Act funds. And that space has gotten a lot smaller over the past few years, not because these are bad strategies, but because they're not suitable for 40 Act funds. And I think that we've seen kind of this evolution of democratization in private credit for a while. You mentioned interval funds, and those have worked out for many people. And that it's one fund in particular has almost a cult following at this point.
You can name names.
A recurring theme.
But we also have the BDCs, and if you kind of take a look at what a BDC is, why do I need the next evolution? Why do I need the ETF if the operator already has a public BDC that I can buy and sell? I don't want to disparage any product. I don't want to disparage anyone's hard work. I just don't get it. I'm not entirely comfortable with it yet. And I'll wait until I am.
I think it's okay to be skeptical for alts in general, but certainly some of these new products that are coming out. I think it's fair to ask the questions as you talk to your alts providers, people that you're getting alts from generally of, are you a technology company or are you an investment firm? Are you a placement agent or are you actually focused on my net risk adjusted returns? And more so, are you just a client or are you actually a longer term partner?
But so just to give a little bit of background, I guess I'll have to name some names. There is a State Street Apollo ETF that was launched just a couple weeks ago. It's a private credit
hadn't heard of it.
ETF. And
News to me.
the way that it's arranged is Apollo is, providing the intraday bids for the stuff that's in the ETF, and it was something that was very hyped before the actual launch, but the SEC came out and had some more questions about it after it actually launched. So, but it is something that's being marketed to the masses, right, to retail investors. So if you are a retail investor and you don't have a couple million and you can't, find another avenue for private credit investment, does the ETF make sense?
I'd say go talk to your advisor, honestly.
That's always a good response. And again, I think what your advisor is going to do is sit down and research what's in the ETF, compare it to the BDC, try to get on the phone with Apollo, and understand which is the best approach. Now, it may very well be that the conclusion is that the ETF is the best choice. It may also very well be that the advisor comes back with a response of, if you can't do it in a private fund, don't bother. And that really is going to be a case-by-case basis. But there really is no shortcut here. You really just do need to compare whatever the options are, understand the risks, understand the added risks with the public vehicle versus the added risk with the private vehicle. It's the fact that you can buy it and sell it every day is great. But that doesn't necessarily mean you're going to be able to buy it and sell it in NAV. And we saw that during COVID also. Even investment-grade fixed income products, you had the net asset value and you had the market price. And that turned out to be a great buying opportunity for whoever took advantage of it. But there's no guarantee that won't happen here. And those are all things that I think people just need to consider when making this kind of decision, and that's what your advisor's for. So
I think it's also, to that point, it's kind of the privately held BDC versus the public BDC argument, where public BDCs, yes, you can buy and sell on a daily basis. There's a lot of volatility. You look at the late 2000s, early 2010s, traditionally a big discount to NAV. There's considerations there where I think people have to think about, again, that suitability and eligibility criteria.
And we have like 2 minutes left, so I'm just going to ask you guys very briefly. Let's say it's a year from now, we're back on stage here at Future Proof, we're talking about private credit again. Where is the space? Just, short term.
I think that we continue to grow pretty significantly. I think there's probably a greater focus than just on direct lending. I think that people start opening up and seeing that bank loans, even CLO products, I think that total return side, I think mezz and subordinated loans really dependent on M&A activity, which has been light this year. I think that special situations distress probably comes back into favor. That sourcing mechanism and the way we think about distress has changed drastically over the last 15 years or so. So I think there's going to be consolidation in the space, but I think that we'll see a lot more people who either A, have realized we've entered some kind of market cycle, or B, are more attuned to the fact that we likely will be.
Yeah, I think we do have more and more conversations about distress. I think we have more and more conversations about special situations. And I also think we start to hear more and more about sponsored versus non-sponsored within direct lending, which, I think today it feels, at least to me, that many operators see it as, a huge advantage to be strictly sponsored. And I imagine that changes, and you see more and more people willing to be unsponsored alongside some sponsored deals.
Well, that was basically me re-inviting all three of us to come back for another panel next year. So thank you guys so much. Thanks for everybody who was in the audience. I hope you guys found the conversation useful. And we enjoyed the rest of the conference. Thanks so much.